Good morning, everyone. Thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TraderBait, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can also trade these on the DOM on TraderBait's main platform as well. They're a great way to get exposure to the futures market with limited risk. You can go to placeyourtrades.com and get the TraderBait web app for free. I also write a weekly blog and daily pre-market overview on the markets that you can subscribe to at placeyourtrades.com. I will be doing a summary of this episode with my key takeaways that'll be available for download as a PDF. And if you're interested in getting this PDF, just click on the link in my feed or visit placeyourtrades.com/spaces to sign up for it. And the PDF overview will be available and emailed out to anyone who signs up. And now we'll introduce our guests. We have Ross Kennedy. Ross is founder of Fortis Analysis, a strategic consultancy that serves public and private sector clients operating at the nexus of geoeconomics and national security. He's a logistics industry veteran and with 17 years of direct experience operating agribusiness, chemical, energy, humanitarian, food, defense, and water supply chains. Next, we have Albert Marco. Albert began work in foreign affairs in Europe as a political consultant for multiple political parties, spending 10 years in Eastern Europe and South Caucasus, including Georgia. During the Russian-Georgian War, he is a registered defense broker for the State Department, specializing in procuring Russian equipment. Since returning from Europe to Washington, he's consulted with many U.S. Congress members in the House Foreign Affairs Committee, Appropriations Committee, and other legislative outfits on Capitol Hill, specifically who deal in international relations, along with working groups on geopolitical risk events, campaign strategies. He's currently a political economic consultant for hedge funds, financial firms, and helping them navigate the U.S. political and financial process. And last but not least, we have Arno Vector. Arno is a market analyst based out of South Africa, providing market analysis and commentary for global market participants. So I want to welcome everybody and thank you for taking time out of your day to be with us. I'm going to start with Albert first because he's got a hard stop at noon just in case we go over. I want to make sure that we get questions in for him. So we'll start with Albert. So with the current events in Israel right now, what is the likelihood of this spreading to other countries, and what are the economic implications of any, if any, and what countries should we be keeping an eye on in this region?
Well, thanks for the intro, Tracy, and hello to everybody. Thanks for listening in. Right to the point, the biggest risk for the markets was Israel entering southern Lebanon and Gaza and having a so-called regional war explode. Well, the problem with that premise is who is going to go up against Israel in a quote unquote regional war? I mean, the only real players here are Hezbollah and Hamas, and with, of course, some proxies that the Iranians, the IRGC, could actually throw up. But as the days go on, the likelihood of like Israeli direct strike on Iran is just becoming less and less likely, and that's what I think would have been the most damaging for the markets. The markets are still reeling with inflation, so any kind of spikes in Middle Eastern violence and tensions immediately starts to bring on the narrative that oil is going to 120 or 200 or 300 or name your crazy price by the sell side analysts. So I mean, from my perspective, I don't really think that this is going to be some kind of Armageddon regional war that brings in Jordan and Egypt and the Saudis and the Iranians and whatnot. I think one of the key players that nobody is really talking about right now is, what are the Turks going to do? What can they facilitate in terms of some sort of peace agreement, economic help for Gaza, and maybe push a little bit back against the Iranians within northern Iraq and northern Syria. So I think those are the things that I would be really looking forward to seeing what happens in the next 10 to 20 days.
Sorry. I forgot to unmute myself. Well, we just found out today Jordan has canceled the summit as it was to host in Amman today with President Joe Biden and Egyptian and Palestinian leaders. So is this something we should be concerned about? What does it mean exactly?
Well, I mean, that was really predicated on the reason because the hospital in Gaza exploded. Now, there's not really concrete evidence that the Israelis did it. The Israelis are denying it, and obviously, Hamas has had a track record of failed missile launches that have exploded within their own territory. So, I think at this point that conference was canceled because of the issue with the hospital. Um, it doesn't look good for Joe Biden, for certainly, because the U.S. looks like they're only pushing for the Israeli side and not a region-wide peace agreement or settlement, specifically with 150 or so hostages still within Hamas's grasp. So I don't really think this is such a big deal. It just was ill-timed event in Gaza with civilians dying at a hospital.
Absolutely. And then I want to move to one more question before we move on to Ross, but I kind of want to move this over to China. Right now, everybody seems to think China is set to invade Taiwan. Everybody, there's a lot of talk about it on Twitter, as you well know, especially with their latest build out of crude storage. People are saying they're preparing for war. So, how really feasible is this? Or, in other words, is this even a remote possibility anytime soon?
Well, there's always a remote possibility of any kind of conflict, as we saw with the Israelis, with the Israeli issue. But I don't, I've been hearing this Taiwan invasion story for multiple years, and each year I keep giving the same answer. The Chinese can't afford it. I mean, the ports would be shut down. Their economy is already teetering on the edge of abyss as it is. I don't really think that the storage buildup of oil is really predicated on an invasion. I think more to the point is they're trying to be a market manipulator of oil. They can see that they can probably sell it for $100 a barrel when they're buying it for 60 from the Russians. So I don't really equate those two things. I mean, the Chinese to have an amphibious assault in Taiwan only have a 2 month window, I believe, to cross the Straits of Taiwan. I mean, those are treacherous waters, and on top of that, you have U.S. submarines and Taiwan defenses that would inflict pretty heavy damages. And I don't think that the Chinese are really in the mood for adventures after what they saw what happened in Ukraine.
That makes absolute sense. And then we will definitely come back to you. And I want to move to Ross right now. Uh, so, given the tensions, obviously, in the Asia, Middle East right now, do we at all need to be worried about the Strait of Hormuz or the Suez Canal? And do you foresee these events affecting logistics at all, aside from what we're seeing in skyrocketing shipping prices?
Yeah, to the and good morning, Tracy. Good morning, good afternoon, good evening, everyone else. Get my Truman Show introduction out of the way there. At this point, the likelihood of a true closure of Hormuz or of the Suez and Red Sea is fairly low. Egypt depends mightily on the income that comes from the Suez. I think they earned $11 billion last year in transit fees and tolls to pass. Hormuz, crosses over into multiple international and national jurisdictions. What I would be watching more for is, unexpected individual incidents, right? Scare quotes that could force commercial shippers, particularly under the risk of losing their insurance coverage for those voyages and for their vessels and crew, to select away from using one or both of those. But we haven't seen the anti-ship missiles spinning up. We haven't seen, from Hezbollah in the Med, we have not seen um, so far any rise in threats to commercial traffic above what's already kind of baked into the baseline in Hormuz or in the Red Sea or at the Bab el-Mandeb or Gulf of Aden, any of those various choke points or higher threat waters, that kind of ring the Arabian Peninsula. So to this point, it's really just a case of ocean carriers, particularly steamship lines, using the opportunity to increase rates, to threaten capacity, these kinds of things. So until we see actual kind of kinetic escalation, attacks on vessels and things like that, we will not have a major disruption otherwise. So that's kind of where things are at today. The big indicators will be ocean carriers notifying clients that they will be taking the long route around the Cape, South Africa, going east instead of west off the west coast of India, for example, sailing Shiva in India, which is, the major commercial container port there in the Gujarat region, northwest India. That'll really be kind of the first indicator that the information is being received by the shipping agents at origin. But to this point, we have not seen any of that. There's still traffic flowing.
And then do you foresee any problems with supply chains like over land?
Natural gas is more of an elevated concern, I think, from an energy side than oil at this point, simply because of the routes of the pipelines, the various motives of the actors involved, disruption, of course, the natural gas fields in the Eastern Med. That's a more elevated risk right now than what we're looking at with crude, and like Albert said, it's the world is still awash in quote unquote sanctioned oil that can be bought at sanctioned levels and resold into the global economy. And so, supplies are still flowing out of Iran, supplies are still flowing out of Russia. This is, a situation that, of course, is a powder keg. As we know, we have seen escalated militia activity, escalated, quote unquote, riots and other demonstrations of anger at the U.S. and U.S. allies. We saw just a mob storm one of the U.S. military bases in Turkey last night, where we have a major radar installation that primarily is directed towards monitoring activity in Iran. You could definitely, and I said this on a segment with Albert and Tony Nash here a few days ago. The Kurds are a bit of a wild card right now. They're the only ethnic group that crosses over multiple hotspots on land in the Middle East. You've got Syria, Iraq, Iran, and Turkey that all have skin in the game in one way or another. And, that certainly bears watching for things that travel over land via rail or truck throughout the northern part of the Middle East up into Central Asia. But here again, right now, the only real ports, rail, roads that face a high risk of disruption are those immediately in the theater of the Israeli conflict. So that'd be, Jordan, Israel, Lebanon, Syria. Could escalate at any time. That changes the calculus. But where things kind of stand right now is that a lot of people seem to be keeping their powder dry and continuing to try to do business as usual from a supply chain standpoint.
And then do you think, there seems to be rising with risks geopolitically, globally. So are we like in a new, we had had a few years of relative peace. Are we in a new paradigm now? And if so, how do we prepare for this? If it seems like the world's kind of bifurcating.
Yeah, it's there certainly is an obvious pattern of escalation and bifurcation to an extent. The paradigm a lot of people have in their mind is kind of BRICS versus the West or the Anglosphere, and India being a major part of that block. I think we'll keep a lid on a lot of the maybe more insane things. But what we do see is the ability of malign actors to coordinate large scale geoeconomic maneuvers, or to time them, even if they're not directly coordinating, but to have a pretty good read on what the other guy is going to do, and then be able to do their own thing. We saw that when U.S. naval assets and marine assets started repositioning in the Med and the Persian Gulf. And then all of a sudden, the alarm bells started going off in South Korea that North Korea was planning Hamas-style attacks into South Korea, artillery missiles, as well. That's the real thing that I'm kind of watching for here is the Navy in particular is kind of the steel spine of U.S. We don't call it naval diplomacy for no reason. And the Navy, for all of its issues, and there are many, is still far and away the most formidable force on water anywhere in the world. What we risk is unexpected, unorthodox, polysynchronous, right, where you have multi-layered timelines in effect that suck in the Navy, but by extension, certainly the Marines and certainly the Air Force, into positioning and fixing assets in multiple theaters of conflict, each of them with their own dedicated supply chain that is a relatively limited supply when you look at how long-term engagements could go, of munitions, of replenishments, of fuel, and that then opening a window, particularly in East Asia, the Western Pacific Rim, for China. The worst case scenario, and this is by no means a prognostication, it's going to happen. The worst case scenario here is that the U.S., for whatever reason, stays pretty anchored with multiple carrier strike groups in the Middle East. We've got multiple carrier strike groups operating in the Pacific right now, but they're kind of out on a limb if anything were to escalate, or if we were to have to respond in some way to provocations anywhere kind of along that corridor from the Strait of Malacca up into the coastal regions of Japan, China, and Korea, and Taiwan. The northern passage out of North China for ocean vessels is something that certainly bears watching. We've seen escalated Chinese activity near the Senkaku Islands in between Japan and Taiwan. That's been a flashpoint, or a potential one, for a long time. Territorial dispute between China and Japan. Chinese Coast Guard vessels have been moving actively into the region and are operating in that theater. What really will determine kind of the shape of the next 6 to 12 months for people who are kind of watching logistics and supply chain risk as a result of geopolitical conflict is going to be what happens, what transpires in Malacca. There's been a surge in piratical activity there, threatening ships. The U.S. Navy and other regional navies have responded to that. But blocking maneuvers, if you will, from January through the middle of 2024, certainly bear watching as you see where the naval assets position themselves. That will largely be determined, I think, by what happens, and I believe it's January with the Taiwanese elections. If a more pro-Beijing regime, kind of ascends, then I think you're going to kind of continue to see China continue to salami slice and continue to operate with Taiwan as they have. If you're talking about the DPP and a more pro-independent stance, retaining power, then at that point, the risk of something escalates. But as Albert said, you've only got a couple of months of sea state, of wind, weather, all those factors that come into play where an amphib assault across the Taiwan Strait, it's a short distance, but navigating those waters is quite treacherous. We're talking about aspects of the PLAN that are very untested in this regard, even if they begin to employ commercial ro-ro vessels and things like that for logistics over the shore operations. Taiwan's pretty inhospitable geographically. So where we would see that would be soft blockading, interdiction of commercial vessels by the Chinese Coast Guard and the PLA. Moreover, is not to start seeing things like choking of key exports outbound from China, increase in export tariffs or reduction in export subsidies that a lot of industries get in China to export out. We'll see that activity, I think, before we see anything physically happen on water.
Thank you. And just a reminder for the speakers, you guys, if you have a comment on somebody's comment, feel free to comment. We can make this as roundtable as you would like.
Well, I got
Just
one.
wanted to.
I got one since you mentioned it. The only thing I would say, well, Ross is correct about the Kurds being a kind of a wild card here, is that pipeline from northern Kurdistan from Kurdistan all the way through Turkey into the Mediterranean has been locked down, and right now they truck everything back and forth to export that oil. I mean, if you have some militias there, especially Iranian militias, start to target those oil shipments and whatnot, and those make it a little bit more difficult to export, you could have a little bit of a problem in the oil market, and specifically for Mediterranean exports.
Well, we'll definitely keep an eye on that. Now we'll go to Arno. I kind of want to talk about the central banks here for a little bit. With geopolitical risks as well as market fundamentals tightening the oil market, pushing up price, of course, do you think this changes the Fed's course at all as far as rate hikes are concerned, or any central bank for that matter? I mean, obviously, none of them count energy in their metric, because of course not. But sooner or later, these prices are going to start to affect everything from, manufacturing to employment. So do you foresee this being a problem for central banks moving forward?
Unfortunately, I think in the short term, no, for a couple of different reasons. Look, we know they should have gone a lot more aggressive than they did from the start. So I think, there's a time frame that it made sense for them to go super aggressive. And I think a lot of them missed out on that. And recently what we've seen happening is we've seen quite a few of them taking a bit of a victory lap, if you will, about getting inflation down. But, we're still close to double the Fed's target, more than double the ECB's target, more than triple the Bank of England's target, where we are from an inflation perspective. So why I think this isn't going to impact their views in the short term is, firstly, if you take a look at their track record, look at what they allowed inflation to get to in the first place before they started to react. Now that they've already done a bit of a victory lap, I think they're going to give it some time, before they allow these short-term events to really impact them. And that's probably not a bad idea anyway. But if you take a look at how these things normally, feeds into the economy, I think one thing that's interesting to note, or important to note, both from a tradability perspective as well as a policy perspective, is that these types of events, as long as we don't get any, even if things remains a little bit edgy in the Middle East, as long as we don't get any major regional conflict breaking out, the thing to keep in mind about most of these risk premium trades is that most of them gets discounted fairly quickly, at least usually. Now, if you look back to the Russian invasion of Ukraine, which is obviously the most recent example we had WTI spike, 30% in 6 days, but it took the markets a whole 5 days to basically trade back to unchanged. Similar story with gold. I think we jumped 8 or 10% in that first week, and that was all basically back to unchanged levels within about 5 or 6 days. So it's important here to note that even though these things, we already try to think about how this could impact policy going forward, but we first need to see how it's going to impact these assets in the first place. And I do think that, like the guys already rightly mentioned, I don't think things like oil is really the big focus, at least for now. Gas is going to be more important, especially when we talk about Europe. I think, even if the conflict remains just as it is right now, that can still put pressure on supply to gas, and that's going to be bad for Europe. That's obviously going to be something that ECB will be thinking about. But again, these guys, we know how slow they are to react. They are going to wait until things get much worse before they start calibrating this back into their policy decisions. So for now, I think it's nothing more than short-term risk premium volatility that we're seeing, and I think they they will look through that for more than one reason. Firstly, they have just, like I said, started their victory lap about winning inflation. We know that's not the case. That's the first reason. Another reason, more specifically on the US, whether they like to admit it or not, there's a lot of political considerations that needs to be made in the next couple of months going into 2024. So I think that's going to be something that plays into the decision making as well. But yeah, I don't think this is really going to change either one of their tacts right now. I think they're gonna give it enough time to wait for it to become a problem first before they start to really act in terms of policy changes.
And then we had Eurozone inflation out today. Annual inflation was down to 4.3% in the Euro area. So does this mean we'll see the ECB pause for a while?
Yeah, I think so. Look, I mean, they should have done a lot more when they could. They had the chance. There was a time when the market was pricing in a much higher terminal rate for the ECB. They should have just put pedal to the metal and really had it stick. Back then, the growth allowed them the flexibility to go a little bit more aggressive. Where they are right now, if you take a look at German data, they can't afford really, from a growth perspective. They should be hiking, but they can't afford to do that from a growth perspective. That optics for them just won't be right. So they should be going more, but they had a window to do that, and that window is basically passed, I think, for the ECB. So where we are right now, the higher probability is that most of them stand pat. Obviously, if this spills over into something bigger, and we eventually see that spilling over into increased inflation, whether that be from freight prices increasing, from a broad-based supply chain perspective, increasing prices. Until that happens, I think they are just going to sing the same tune they've been doing over the last, let's just call it, quarter or so.
And then the thoughts on the Fed? First, let me rephrase this. First, do you think that the Fed is going to pause, or you think they have one more in them for this year? And then what are your thoughts on our rates? Was it too high, too fast? And do you foresee anything breaking, or are already seeing signs of things breaking?
Oh, that's such a good question. It depends on who you ask. I think, if you take a look at one part of the market, they'll show you a whole string of things that's already been breaking. And then there's a few other things that just, keeping in there. I think what makes it really tricky is that you're always going to have a lag with which policy makes its way into the economy, and trying to time that lag, with something like a yield inversion. It's useless, because we just don't know. Every time it's going to be different. In terms of the Fed, I think they should be going more. One could also argue what will one more hike really matter anyway? That is, I think, a valid point that they'll look to deliberate, asking themselves whether one more would really make that big of a difference. The thing is, if you take a look, they are still holding on to this idea that that they can bring inflation down to target with a soft landing. And I just don't think that's possible. I think something would have to break for that to change. The labor market is still super tight right now. Growth is still holding up okay. And yes, there's many metrics you can cherry pick to say that that's not the case. But, let's not kid ourselves. The economy has held up much better than majority of the markets, me included, anticipated at the start of the year, based on policy tightening. So bottom line, I think they should do more, but from a political perspective, they probably don't want to right now. That I think complicates their job a lot. But again, if in the end it's going to come back down to inflation, they would need to see a harder landing, in my opinion, to bring inflation back down to target. At the speed that we're moving right now, I just don't see us getting there anytime soon. From a trajectory perspective, we had Goolsbee coming out saying that the move we're seeing, the move lower in inflation, is not a blip. How can they trust themselves, in terms of their forecast for inflation? If you take a look at their track record over the last 2 years, I think they should have approached this with a little bit more humility, with a little bit more optionality. they could have just left the door open. I think it was unnecessary for them to guide towards a pause, because now, even if the data allows them to hike, they'll need to walk back on all of the pause language that they've gotten used to over the last 2 weeks or so. So I just think they've communicated themselves into a pause. That was probably a mistake. But again, with where inflation is now, they could probably get away with pausing both in November and December. But inflation isn't over. If you take a look at the recent data, core goods prices have basically stopped going down. Core services inflation has broadened. I mean, if you remove everything that caused inflation, then there hasn't been inflation, of course. But those things that really matter is showing them that the fight isn't over. So bottom line, I think they communicated themselves into a pause, which is putting them in a very difficult situation. Looking at the data, they should probably do more, but politically, they're probably not going to.
Thank you. And now back to Albert. Albert, what are you I want to switch this to the U.S. A little bit. And first, what are your thoughts on the Fed, particularly going into an election year next year?
Well, I think Arnold was right that this is definitely a political. There's a lot of political calculus being done by the Fed because of the White House's leaning on them. I think that we are probably going to have a rate hike November 1st, and in anticipation of trying to do a Santa rally going into the end of the year. I think that the Fed is really keen on keeping the Treasury and the White House a little bit happy and hoping to rally the markets in some way, shape, or form, probably bringing down the dollar. Maybe talk of a pivot, maybe talk of cuts. I don't see. Of course, this is all dependent on what inflation is going to do, and I just as Arno's was just saying, I don't think that they're going to be able to bring inflation down anywhere near their target anytime soon. I think that the geopolitical problems that are facing in the world right now are just headwinds in that policy and planning that they're trying to implement at the moment. So I just like I said, with the Fed, it's rate hike November 1st, probably talk of a pause or maybe talk of cuts and lower the dollar into next year for the election.
And then I'm going to talk a little bit about this current Speaker of the House drama. So first, how long can we go without a speaker? It's been 14 days already. And then what are the market implications for this, especially when we have another government shutdown looming in like a month?
This is a real problem. This is a problem that I don't think the market is really pricing in at the moment. There's 8 appropriation bills that need to get done before that shutdown talk starts to happen, and we don't have a mechanism to bring bills to the floor in the House because there's no speaker. Jim Jordan's most likely not going to make it as the speaker. At that point, there's another week or 2 week scramble. So the clock is ticking right now till the next shutdown. Dilemma happens. So it's a real problem. It's a real problem.
And then, let's talk about Yellen, your favorite subject, for a little bit. So Yellen came out the other day basically and said, absolutely, the U.S. can fund 2 wars right now and do everything else that we need to do for the country. So what are the implications for this domestically, and when do we get too stretched?
Well, that's interesting. And this is going to go back to the budget with the shutdown and back to the appropriations bills. So she could say that right now, but if we don't have appropriation bills done and a budget, there won't be any funding for these wars. And that's where the political calculus comes in. And the Treasury, Yellen doing the bidding of the White House, is to push this narrative. It's like, look, the Republicans are the ones holding up funding for the government, funding for the wars. The chaos is because of A, B, and C, and don't look at us. And I think that the reality is, yes, the U.S. can fund it, but the fact remains we need to have a budget in place to do that. So that's what I would that's the caution that I have going into late November and early December.
And then what are the, obviously Yellen is keeping the USD elevated, it helps export inflation and make it not seem as bad here, but what are the implications of this, and what do you foresee, if we keep the dollar this high for how much longer? What are the implications for the markets, and what are the implications for the global markets?
Well, I mean, the dollar is the dollar policy set by the Treasury Secretary, and that's Yellen, and her idea of combating inflation is keeping dollar up at these elevated levels. The problem that happens is when there's a geopolitical event or some kind of systemic breakdown and the dollar starts to jump up to 110, 113, God forbid 120 on the Dixie. That has massive ramifications for emerging markets. Massive. I mean, it, it's really destructive, and even to the Europeans, it's really destructive. And we had to intervene last time and bring it back down to earth because 113 was causing Europe's financial system to buckle. So we have to be keen to watch those levels. I think 110, 112 is pretty much where it's going to top out before Yellen interjects once again.
And then right now, in your mind, what other areas geopolitically should we really be watching right now? And what are some next potential hotspots?
Well, I mean, it's see, that's tricky, Tracy, because everyone wants to start pointing to other frozen hotspots like Armenia, Azerbaijan, Kosovo, and Serbia, and whatever. Go on down the line of whatever hotspot you want to. I don't really see those hotspots flaring up. And then if they did have some sort of skirmish, I don't think that it's really a market event that would take notice. I mean, Kosovo and Serbia, the United States has a military base there, Bonsteel, right? The Serbians were decimated and don't have the money to launch a war, besides maybe shooting a few AK-47s over the border. I mean, Armenia and Azerbaijan, that's a proxy war between the Russians, Iranians, and the Turks. They're not really on really terrible terms with each other, so I don't really see that thing flaring up into anything dangerous. Besides that, the only thing I always keep my eye on and is always India, China on the Himalayas, and even in the Indian Ocean. I think that you could have a fishing vessel of the Chinese cause a couple problems, or another little skirmish on the Himalayan mountaintop region. So that's the only thing that really keeps me up at night is the Himalaya problem with the Indians and Chinese.
Water scarcity, right?
That's exactly right. You have one water source feeding 1 billion people on each side of the border. It's a problem that's going to fester at some point in the future. Is going to be, pretty nasty.
All right, thank you. And then back to Ross. We're seeing a lot of resource nationalism, what I call nationalism lately. For example, the India rice export ban. We're also seeing a lot of countries slapping export duties on many commodities. Do you think that this gets worse and that we will, as we kind of run into some serious commodity scarcity, particularly, say, metals for renewables in the coming years? We all know that we don't have enough. And what is that going to mean what is that going to mean globally, and what is that going to mean for, say, the green transition timeline?
I mean, that's a great question. Resource nationalism certainly is on the rise, and what the dog not barking here in a lot of these analyses. The reality is that most analysts just take a very surface level view of the problem, and they just look at availability of the raw commodity. For me, what I'm looking more at, particularly when it comes to materials, most materials that go into renewables don't come out of the ground as just that. They come out they have to be refined, chemically extracted, filtered, reprocessed, and numerous different ways. A lot of them, and then ways that probably the EPA would be pretty negative on doing in the U.S. But that to me, more than availability of the raw material, is the bigger issue. The U.S. has access to a lot of things within our own within our own soil here, certainly in the United States, certainly in Alaska, a massive trove of probably half the things that are on the list of critical strategic materials that we're import dependent on right now in the ground. But even more than the extraction is the refining and remanufacturing capacity to turn them into intermediate or finished minerals or materials that can then be readily converted into high technology type things, whether it's semiconductors, microprocessors, photovoltaic cells, magnets for the motors on the wind turbines, all of these sorts of things. We're not as deficient on the raw material side. We're incredibly deficient and dependent on a number of malign actors, potentially, especially China, for the refining and the extraction, the refining, of them. And that's really where we had to get serious 20 years ago. We definitely had to get serious 10 years ago. We're way past critical today in materials manufacturing, remanufacturing, and refining capacity for a lot of these things. So resource nationalism doesn't just choke us on the raw material side. We can solve for a lot of that pretty expediently, even with just a change in administration and mining policy. Where we really are behind the eight ball in the West at large is conversion of that raw material into usable critical strategic materials, and you can only stockpile so much. And the U.S. doesn't have a tremendously focused or disciplined stockpiling effort. DLA does what it can under its critical material stockpiling program, but those are really more about maintaining just the most bare levels of emergency supplies of like 40 different things, where really the real number of things we should be stockpiling and refining and stockpiling for ourselves is, that list is more than 60 materials and commodities. So, I'm kind of at the place where the issue is urgent enough as a supply chain guy that setting aside, what we should be doing from a shipbuilding side, from a sustainment standpoint of our surface vessels, of our subsurface fleets, certainly expanding the merchant marines, provisioning the Coast Guard a lot more aggressively with ships and materials and manpower that they need, is refining capacity, in situ refining capacity in the U.S. adjacent to major ports that are easily accessed by vessels that can draft deep, and having a committed plan and infrastructure inside the United States to transport all of that, all of the intermediate and finished materials to the places that need them, where they can be turned into value-added stuff. So we're 20 years behind the curve at this point, and it'll take a little bit of a not only awareness across the entire U.S. government and private sector to do this, but it'll take many billions of dollars in capital and subsidies, and really a coordinated, concerted effort to get us safe as far as our strategic reserves and as far as our ongoing commercial capacity to process and transport these things.
And since you brought up stockpiling, what's your thought? I would like your thoughts on the SPR drain. And it's not only the Biden administration. I would throw in there that Congress has been using this as a piggy bank for years. So what are the risks here? Is the government being too short-sighted? Can it be fixed? Can you talk about this a little bit, please?
Yeah, biggest part of the issue with the SPR is, it's governed and largely paid for, out of congressional and executive branch purse strings. You've got a lot of fingers in the pie at the regulatory level. You've got a couple of private sector actors, I believe it's Exxon and Chevron, that actually manage the daily operations of the above ground and below ground storage capacity to do it. The SPR serves an extremely vital role, but it should be pointed out that most of the focus of the program is on crude or raw material. It's not on distillates, blends, capacity to maintain a sufficient emergency stock of all of the things that the world actually runs on. I mean, you don't go to a gas pump and put heavy sour right into your tank. It's a refined material, and just like with minerals, the refining issue in the United States is so overblown in our circles, all of us that are listening to a session like this. But from a public awareness standpoint, the SPR is just kind of this just vague sort of stockpile of something fossil fuel related, and being able to connect that to policy and push individual congressmen, senators, push the administrative, various agencies, push the private sector actors, get them out of the way, get refining, expanded, get the ability to transport refined material, to store it and life cycle it properly. It's a major issue. It's a completely mismanaged program. And like you said, it is more or less treated as a piggy bank. The other issue is that the DoD, for as vast and mighty and capable as it is, really, really, really sucks at supply chain management. And where the risk comes in is the assumption is, well, the private sector can pick up the slack of USG and DoD mismanagement. It really can't. If you look at just the amount of time it takes to get an aircraft built these days, the cost, the terrible life cycle management parts and sustainment supply chain for things like the F-35, it took 20 years from the time the Ford was had its the first part of its keel laid to actually fielding it as a combat capable aircraft carrier. 20 years is way too long, and that's because of the mismanagement of all of these programs. It's also because of the ability to process and manufacture all of these things that go into our platforms, but then to sustain them. The largest fuel, in situ fuel storage capability on U.S. soil was Red Hill, as far as naval operations goes. And Red Hill was a World War II facility, I believe, and I hope Sal, probably owner John Conrad's on here, they can correct me, but we're talking about essentially a 70 to 80-year-old underground fuel storage farm that is shut down and actively being defueled ahead of schedule. And so the DoD has its own issues where, we've got the massive, the largest war machine in the world, but boy, are these platforms thirsty. They need an awful lot of JP5, JPA, diesel marine fuel in various blends. So the DoD not having its own strategic capability to life cycle manage and store sufficient supplies of fuels is an enormous issue that really is adjacent to, but also separate from, the SPR and the various mismanagement thereof. We are not a serious country about, in any way, the current state of affairs, that we're still a nation that largely runs on fossil fuels. We don't have sufficient reserves of anything really that we need, except for a certain level of crude, and we continue to treat it like basically, as you said, a piggy bank, that every time we want to act like a spider and reverberate the web a little bit and goose prices or create some sort of market effect, we drain the SPR, we fill it, we do whatever, but that's just an absolute failure of imagination, absolute failure of proper management for these critical resources on the energy side that the U.S. needs.
And then one more question, we'll go to Arno. What's your thoughts on, obviously, since Russia and China have always had an alliance, but obviously since the Russian invasion of Ukraine, they've been pushed even closer together. And so what is the impact on global commodities? Because we've seen them do a lot of big deals lately, including one just yesterday for the largest agricultural deal in history. So what effect does this have on the global market and the availability of these commodities elsewhere?
Tracy, I apologize. Which two countries did you mention?
Russia and China.
Oh, well, I guess I probably could have guessed that by context alone. Russia, in a lot of ways, is Russia's going to do what Russia's going to do, and Russia will follow wherever their alignment of interest is. Even when we see India and China getting sporty, Albert mentioned, certainly a potential flashpoint that that I'm watching as well from a logistics perspective, and seeing if assets are moving is certainly the high Himalaya region where India and China border one another, and the only hot conflict between those two countries, skirmishes on that particular border. Russia continues to trade extensively with India, continues to be a major partner for them. And at the same time, even while these conflicts are going on, maybe between India and China, there is a connectivity of trade happening between India and China. We're also seeing that Russia and China continue to deepen their ties as well. So Russia, like India, is going to trade with whomever they need to continue to keep their economy going. For all of the ways in which Russia has mismanaged its war machine and mismanaged, from its side, me not taking a side, just speaking objectively, but certainly mismanaged what we can assume their military objectives would have been in Ukraine. They're still cranking out material. They're still sitting on vast reserves of very important strategic minerals and metals, whether it's uranium, palladium, platinum, all these types of things. And they continue to trade those on the world market. They either just trade them directly where they can, or when the sanctions are in play, they two-step them through, primarily through China to get them into the world market. But there's an interesting wrinkle here in that northern China is water deficient. They get, heavy rains and, periodically, and we see the stories about flooding and cropland and villages washed away and all of that. But when you look at, and I'm going to totally mispronounce it, but like Tbilisi, which is in southeastern Russia, it's the largest deep water lake in the world, and Russia's actively building a pipeline from there through Mongolia into northern China. That type of infrastructure play, that type of trade, where we're talking about the three things that make the world run: food, water, and energy. They're closely integrated with China in a number of ways. On the flip side of that, what we saw over the last year is that a lot of Russian animal nutrition companies that are creating feed for the commercial protein supply chain in Russia were banning the sale of various Chinese manufactured amino acids and minerals that go into the animal feed supply chain. So there are ways in which the U.S. from a commercial side can intervene into that. But on balance, what we're seeing Russia do is play a pretty intelligent game in a lot of ways, where they're absorbing the sanctions by two-stepping or by getting creative with how they manufacture their trade deals and sell and transport the pretty significant sums of critical materials they have. I don't see that changing anytime soon. Push comes to shove, I think Russia and China more closely align. But to the extent that Putin is not forced into a choice, he's going to continue to play the game of trading with whoever will trade with him and with his economy to be able to keep things going. In Russia, and I think China, you're going to continue to see be a very significant leading trade partner for Russia and vice versa.
Excellent, thank you. And then to Arno, and then we'll do the final round. I want to talk about the BOJ had to step in today when the 10-year JGB hit a new decade high with an emergency bond buying operation. So should we be worried about this? And will they intervene meaningfully in the yen? We keep bumping up against that 150 level where everybody gets very uncomfortable. And if so, how does this affect the carry trade? And what does this mean for global markets in general? I know that was a lot. So start with the first part was, should we be worried about the fact they had to step in with an emergency bond buying operation?
Well, I think firstly, the only people that should be worried about their emergency operations is the BOJ themselves. We all know that what they're doing right now is unsustainable. At some stage they would need to make a pivot, but they've been at this for such a long time. It's very, very difficult for them to unwind what they've basically accumulated over the last 2-3 decades. So it's very, very difficult. I don't think this is a big surprise for the markets, though. Whenever we've had these spikes to the upside in global yields, mostly driven of course, on the US side, whenever we've had these moves to the upside, we know that they've been there to step in and push the market lower. And they will just continue to do this for as long as they need to, right? It's in the very long time, it's unsustainable. But for the next, 6, 12, 18 months, they can just go at this for as long as they need to, and as they've done for a very long time. In terms of meaningful intervention for the yen, I probably get 20 questions a day on this. The honest answer is who knows? The one that we had, well, potential intervention / maybe risk, a rate call, whatever it might have been a week and a half ago. Whether that was intervention or not, we don't know. It looks like intervention to me. Look, let's pay attention to 150. Now, if we get there, I would be very careful of expecting a definite intervention, because just like last year, we saw them jumping in at 146. They allowed it to run all the way back up to 152 when they started to pull the trigger again. And back then, we actually had a couple of things that moved in their favor. We had yields obviously pushing lower because we had the peak inflation narrative hitting the markets back then. The dollar put in a massive load to the downside. We had a lot of intervention coming out from China as well. That, I think, did a lot of their work for them. If we didn't have that move, we probably would have seen them intervene again. So we know the pain trade for them is between 146 and 152. But it can be any one of those levels, right? Whether it's 152, whether it's 150. I mean, who knows? We'll see when we get it. In terms of how this affects the carry trade, as long as yields keeps on doing its thing, the carry trade remains alive and well, in my opinion. There's obviously a lot of risks. From a carry perspective, I think as long as yields keep on doing what they're doing, the carry trade will remain alive, especially going into year end. The one outside risk factor we need to watch is obviously what volatility will be doing. If there's been this anticipation going into the end of the year that as long as yields, remain where we are, as long as we don't get any major, major flows in the equity space, it's going to be a low vol carry trade positive environment. Whether that plays out, again, it's going to be largely down to yields. As long as they continue doing what they're doing, yes, there's risk that the yen or that the BOJ or MOF intervenes at these levels, but it hasn't stopped the markets testing their resolve, right? And they're going to keep on at it. There's other ways you can go about it. If we always look at the yen from a carry trade perspective, but we shouldn't ignore the euro. Euro mix is normally a very good way to express that. If you've got a positive carry low vol expectation, then I would play Euro mix in this environment. I wouldn't really be touching the yen because you've got that risk. I think the one thing that they did do right with these interventions, or was it a rate check or whatever it was, a week ago, I think the one thing that they do right with these moves is that they make traders and investors cautious, right? If you really wanted to trade, in this example, if you really wanted to trade carry, like I said, I would opt for Euro mix. I wouldn't be touching anything yen related because the risk of them stepping in is too great. And I think that's exactly what they want to accomplish with these interventions. They know as well as we do that it's not going to stop the trend. But I think what they're just trying to do is make it very costly for you if you want to try and express that view through the yen. They would rather opt, push you in another direction, like something like Euro mix, for example. So I think that is, if you want to trade carry, that's probably going to be the quote unquote safest way to do it. With them in the mix right now, it's just a little bit too risky.
And then as far as, with the geopolitical risk globally, do you feel like this is going to play a large role in inflation, meaning central banks are going to have a difficult time reining this in?
Well, I mean, let's first see how it plays out. The one thing that I think they really need to pay attention to, whether they will or not, time will tell, is I think shipping costs is a big thing. You mentioned that earlier. We've seen a huge jump in that already. Let's wait and see. It really depends on how all of this flows into actual inflation. Right now, like I said earlier, I think they have the time to just, kind of sit back and see how this impacts things. And that's probably going to be their choice. If it does escalate into something nasty, especially looking at Europe, I think they will probably feel this first from a gas perspective going into winter. that's probably going to be a first area to watch. I would be watching gas prices fairly closely from a European perspective, from a policy point of view. But in terms of the others, it's going to be a flow through, and we'll need to wait and see how that impacts actual inflation. Like I said, if things just kind of calm down, even if it stays edgy, but we don't see any major escalations, these types of risk premium flows tends to make its way out of key asset classes fairly quickly. But where I think we could have that spillover effect, and this is really where I would be watching, and where I would hope they would be watching, is how this impacts global trade in any way. Ross and Albert already mentioned that, from a med perspective, from a shipping perspective, I think that's where the inflation will come from. If we're going to get more inflation from this, it's going to be from that. If insurance cost needs to rise, if we have major delays to supplies like we had last year, I think those are the types of things that'll actually feed into inflation later on. But it's impossible to tell whether that's going to have a material impact, in the months ahead without knowing what's going to happen.
Excellent, thank you. And we're coming up on the 12 o'clock hour, so we'll do the final question round. It's the same question for both of you. Basically, you can talk about something that we didn't get a chance to talk about that you feel is important, or what should we as investors really be focused on over the next 12 to 24 months? And we'll start with Ross.
So the next 12 to 24 months, I'd say the biggest thing that I'm looking at is the US's policy posture on anything directly associated with or adjacent to reshoring or ally shoring, friend shoring, whatever terminology is hot this week. But what, as a matter of concrete policy, are we doing to incentivize, particularly in critical industries, particularly in critical industrial sectors like refining of energy or materials, shipbuilding, which I just completely harp on. We're a maritime dependent country. The vast majority of things we consume are brought into this country. So I look at those from all the way down to what's the impact to not from Wall Street, because in a lot of ways I really don't give a damn about Wall Street, but at Main Street, at the Main Street level, what policies are we putting into place that will bring jobs back to the U.S., tangible jobs, not more service industry jobs or things like that, but things where we're actually making things again, or the building materials, the building blocks of making things for ourselves. That, I think, will determine, over the next 5, 10, 20 years, the shape of what our economy looks like, or if we're going to be in this position where we continue to have to play, interest rate games. We have to continue to try to pull all the various levers at the Fed level and at the policy level to fight the next fire. But then in the course of putting out this fire, we set the next house on fire. If we get serious about these things, which I have in some ways low confidence in, and other sectors higher confidence, that's really what I'm watching, and would encourage anybody who has reached to a specific congressperson, is in a key decision-making role at a company where the decision point is to move manufacturing capacity out of China. Well, gosh, do we send it to Vietnam? Do we send it to Malaysia? Do we send it to India? Whatever it may be. Do everything you can to try to influence the kind of policy that brings the manufacturing and things back home, shorten the supply chain, de-escalate the complexity, and thus opportunity for chaos, so that we stop stacking up all these grains of sand on top of the sand pile that could cascade at any moment.
And thank you. And Arno, the same question, something that we didn't get to discuss that you wanted to talk about, or what should we as investors be keeping an eye on over the next 12 to 24 months?
Thanks, Tracy. I think, the biggest one on my side that I'll be watching, in an environment like this, relative attractiveness, I think, is always a winner. So my biggest focus right now, in a world where you've got global bond yields rising rapidly, you've got central banks that all hiked more or less at the same time, more or less, aggressive, some a little bit less, some a little bit more, of course. But you're in this environment where you have this synchronicity, where yields are rising across the board. You've got rates that went up across the board, now potentially going to stay flat a while, then either move higher or lower, depending on how the economies develop. In that environment, the area where I would be looking to extract the most value from would be looking at the relative attractiveness for things like growth and inflation differentials for economies. Part of the biggest focus that we from an analysis perspective focus on is currency risk, and I think that way a lot of the interesting plays can come out from the next 12 to 24 months. We've had this equity chop playing out, and there's a lot to be said about equities, but for me, currencies is going to be a big focus point. I think even though you would expect an environment where rates either stay flat or potentially push lower in the next, let's just call it 12 to 24 months, there's going to be lags. Some of them will be moving a little bit quicker. Some will be moving a little bit longer. Some might even be going at it a little bit more from a height perspective. That's where I think the biggest focus will be. Looking for value, will be looking for those relative plays where I just find that a lot simpler in this environment where you have a lot of the synchronicity. Finding those examples where you think growth will be holding up a little bit better or obviously a little bit worse, and then looking for those relative value plays. That's where my biggest focus will be over the next 12 to 24 months.
Excellent. Thank you. And Albert had to go because he had a flight to catch. But I want to thank you, gentlemen, for taking your time out today to speak with us. Please follow these guys. They put out a lot of great information. Follow Place Your Trades to find out what they have going on over there. And with that, thank you, everybody who attended as a listener today. We really appreciate it. And we will see you next Wednesday. Thanks, everyone.